everyone, and welcome to our July 2026 market update. I'm Michelle Jakubowska, Marketing Associate here at Ramapho Wealth Advisors. Joining me today are James Sahagian, Managing Director and Wealth Advisor, Alex Tirso, Wealth Advisor, and Yan Bin Lin Sim, Client Service Manager. And all three are certified financial planners. Today, James and Alex will be sharing their thoughts on the market and the economy. And before we wrap up, Yan will leave us with a few important client reminders. So with that, I'll turn it over to James to start us off on our mid-year market update.
Thanks, Michelle. Hello, everyone, and thank you for joining us for our 2026 mid-year market update. Today is Thursday, July 16th, 2026. As we're now past the halfway point of the year, I thought it would be a good opportunity to step back from the day-to-day headlines and take a broader look at where we are, what's driving the markets, and what we believe investors should be paying attention to as we move through the second half of the year. If there's one word that best describes the first 6 months of 2026, it would probably be uncertainty. Investors have had to navigate a rapidly changing geopolitical landscape, renewed trade tensions, conflict in the Middle East, evolving expectations for interest rates, and continued questions surrounding inflation and government spending. At times, it has felt as though the market has been reacting to a new headline almost every day. Yet despite all of those challenges, one thing continues to stand out. The underlying economy has remained resilient. Corporate earnings have generally exceeded expectations, unemployment has remained relatively low, and consumers continue to spend. Businesses have also continued to invest for the future. That's an important reminder that while headlines often drive short-term market movements, long-term investment results are ultimately driven by economic fundamentals, corporate profitability, and disciplined investing. During today's update, I'll walk through several of the themes we believe are shaping today's investment environment. We'll discuss why geopolitics is playing a larger role in financial markets than at any point in recent memory, how inflation and interest rates are influencing both stocks and bonds, and why diversification continues to be one of the most valuable tools investors have in navigating an increasingly complex world. As always, our objective isn't to predict every market move. No one can consistently do that. Instead, our focus is on understanding the forces that are driving the markets, positioning portfolios thoughtfully, and remaining disciplined through periods of both optimism and uncertainty. With that in mind, let's begin by taking a look at what's been supporting this market this year and why, despite the volatility we've experienced, the fundamental backdrop remains more constructive than many investors realize. Despite the volatility we've experienced this year, one of the most encouraging developments has been the continued strength of corporate America. This chart highlights three key drivers behind the market's resilience. First, earnings growth continues to accelerate. Second, companies are generating healthy revenue growth, indicating demand remains solid. And finally, profit margins continue to expand, demonstrating that businesses have been able to manage higher costs while maintaining profitability. Markets ultimately follow earnings over time, and these trends suggest the fundamental backdrop remains constructive. While we should always expect periods of volatility, healthy earnings growth provides an important foundation for long-term equity returns. One of the biggest surprises this year has been just how strong corporate earnings have been. Going into the first quarter earnings season, analysts had fairly modest expectations. Instead, companies across nearly every major sector delivered results that exceeded forecasts, with technology, communication services, financials, industrials, and even many cyclical sectors producing stronger than expected earnings growth. One can't help to think that increased productivity driven by artificial intelligence has been a key factor to driving the stronger than expected earnings. This is an important reminder that while headlines often dominate the news cycle, earnings ultimately drive stock prices over the long run. The market's advance this year has largely been supported by improving corporate fundamentals, not simply investor optimism. A common question we receive is whether today's market has become too expensive. This slide illustrates how we think about valuations. Stock prices are driven by two primary factors. One, how much companies earn, and two, what investors are willing to pay for those earnings. Earlier this year, earnings expectations were considerably lower. Today, profit forecasts have improved meaningfully, which means the market doesn't require a dramatic expansion in valuation multiples to justify higher prices. In other words, stronger earnings, not excessive optimism, continue to support today's market levels. That's a much healthier backdrop than one driven purely by speculation.
So we've looked back at what's driven the market so far this year. As we turn our attention to the second half of 2026, what do you see as the biggest theme for investors?
As we look towards the second half of the year, our outlook centers around three broad themes. First, we're operating in what Raymond James refers to as a new world order, an environment where geopolitics, trade policy, fiscal spending, and national security increasingly influence markets. Second is what they call Goldilocks and the new chair. The Federal Reserve continues trying to balance economic growth with inflation. Interest rate expectations will likely remain an important driver of market performance. It's important to note that coming into 2026, the consensus was that we would get multiple rate cuts throughout the year. Currently, the consensus is that the next Fed move would be a rate hike. This is a reminder that future moves by the Federal Reserve are uncertain and data dependent. Finally, we believe that investors should continue rethinking diversification. Leadership has broadened beyond just a handful of technology companies, and opportunities are emerging across different sectors, asset classes, and regions. Maintaining a diversified portfolio remains one of the best ways to navigate an increasingly unpredictable investment landscape. Throughout the remainder of this presentation, we'll take a closer look at each of these themes and discuss what they may mean for investors. The first half of 2026 reinforced an important investing lesson. Markets are increasingly reacting to headlines rather than just economic data. We experienced tariff announcements, conflict in the Middle East, shifting interest rate expectations, and ongoing geopolitical uncertainty. Each created periods of volatility, but importantly, each also demonstrated how quickly markets can recover once investors refocus on corporate earnings and the underlying economy. Going forward, I believe investors should expect more headline-driven volatility, but not necessarily long-term impairment of quality investments.
You mentioned that geopolitical events are becoming increasingly important to investors. Can you expand on that?
One of the biggest structural changes occurring globally is the move toward economic self-sufficiency or deglobalization. Countries are investing heavily in domestic manufacturing, securing supply chains, and reducing dependence on geopolitical rivals. The relationship between the United States and China continues to evolve, and governments worldwide are prioritizing national interests over globalization. This isn't a temporary trend. It represents a long-term shift that is likely to influence where capital flows and which industries benefit over the next decade. As countries focus on becoming more self-reliant, 4 industries stand out as strategic priorities: semiconductors, energy, defense, and rare earth minerals. Governments around the world are directing enormous investments into these sectors because they are viewed as critical to economic security and national defense. Rather than chasing short-term headlines, we're paying close attention to these long-term secular themes that may create investment opportunities for years to come.
Thanks, James. Another topic that's been getting a lot of attention is government spending. What should investors know about that?
One issue we can't ignore is the growing federal deficit. As interest costs consume a larger share of government spending, policymakers will eventually face difficult decisions regarding taxes, spending, and borrowing. While we don't see this as an immediate crisis, it is one reason we believe interest rates may remain higher than investors became accustomed to over the last decade. That has meaningful implications for both stocks and bond investors.
Thanks, James. Alex, let's turn to you.
Thank you, Michelle. So picking up where James left off, talking about the deficit, obviously that'll affect interest rates, but also can potentially tie into inflation. So in this chart in front of us, we're looking at inflation going back to 2020. And what you'll see is really since a 9% peak in 2022, we've had a steady and progressive decline. And pretty much all of 2025 and, the first few months of 2026, we were in between that, 2.5% and 3% range of both headline and core inflation. But since the onset of the Iran conflict, we've seen a little bit of a spike to the more of the mid-3 ranges for headline inflation. And, headline inflation does include energy. And if we did, strip out or take a look under the hood of, headline inflation and see which underlying segments were really causing this uptick in inflation we've had over the past 3-4 months, we would see that the vast majority is being driven by energy, right? So we know, the war and all the issues going on with the Strait of Hormuz, where 20% of Earth's oil comes or is transited through. Obviously, that has a disproportionate effect on the price of crude oil, which has a very strong effect on the price of energy, which ties into overall inflation. So, we were obviously trending in the correct direction on inflation, but time will tell how this will play out. As of the past 3 months, it has reaccelerated. If the Strait of Hormuz situation resolves itself, we could see both headline and core CPI getting below 3 again. So here we're looking at the futures implied Fed funds cuts by FOMC meeting, showing the full year, right? So starting in January, we had both the July, September, October, and December meetings all plotted on this chart. And what you'll see is we had come into this year, into 2026, expecting that there would be multiple rate cuts by December. So December is that dark blue line, right? So you see 2.5 cuts. Each cut means a 0.25% rate change, right? So 2.5 cuts, would have been somewhere near, 75 basis points or, 63.75 of a rate cut. So you'll see as time progressed and as we got towards the end of March, we went from expecting 2.5 cuts to really expecting rates to be unchanged. And this past month in June, we've changed from unchanged or no change in rates to expecting more than one rate hike by the end of the year. So we've had a huge swing in expectations of where interest rates will end the year. So that has a strong effect on any interest rate sensitive asset classes, companies that need to borrow a lot, or fixed income or bonds are directly impacted by changes in interest rates. So that is why we have seen bonds perform pretty much flat this year. They haven't really given us much in terms of return, and that is due to interest rates having peaked up again. So we have had a genuine reversal from what was potentially going to be the onset of a cutting, or what was already the onset of a cutting cycle, to now more of a tightening bias. You cannot turn on the news today without hearing about the K-shaped economy. And what this slide is showing us on the left-hand side is we have consumers broken down into income cohorts, right? 5 different quintiles. So the first quintile is those that have the lowest incomes, and the fifth quintile is those that have the highest incomes. And what we'll see is the first quintile spends about $35,000 per year on expenditures, and the highest income quintile spends around 150,000. So a huge difference in terms of absolute spending, but also importantly to note is how much does that spending represent of their income? And we see the lowest quintile, is stretched, right? They are having to spend more than they have coming in, whereas the top quintile is only spending about 50% of their income, so they have significant room to continue to power this economy forward, spend more. Um, and this is what we're talking about when we say the K-shaped economy, right? We have one half of the economy that are the non-asset owners that really have not participated in the wealth creation that's taken place since 2020. And we have those in the higher or the higher end of the K, or the asset owners that have seen their net worths and their income grow disproportionately to the rest of the economy. So does this look like the beginning of a bear market? Many investors are concerned with how well the market has done, the magnitude of the market's rise since 2022 when it troughed out. And what we're showing you here is a lot of investors will focus on the Mag 7, large cap growth companies, mega cap tech companies that they say have driven this entire market forward. You keep hearing about concentrations of the index and it really being concentrated in a handful or 10 names or so. And while there are definitely inklings of truth in those statements, we index this back to 2016, which is 10 years ago. But really, if you just look starting at all the way to the right in 2026, you'll see that, yes, the S&P 500's earning growth has been tremendous this year. If we strip out the magnificent 7 names, we see in that teal line that still growth has been strong, even without those 7 names that everyone attributes all the growth to. If we stripped out the sectors where all the growth is being attributed to, which is information technology and communication services, and look at the gray line, you'll see that growth has continued to be broader than just those tech sectors. And even if we went beyond the United States borders, we see that EFA, which is representative of European and Far East markets, the green line is also seeing growth. And emerging markets, which is really been largely due to Taiwan and South Korea, the semiconductor and the whole chip story. We've seen meaningful growth in 2026. You can see that line has really gone, parabolic, really shotting up here in 2026. So it's not a story of just a few names. It really is a broad earnings growth story. And, bear markets usually do happen with earnings declining. And as you can see by this chart, that's not the case really anywhere that we're looking today. Higher margins support higher valuations. So each dot that you see here is a month that's showing you the forward PE ratio plotted against the forward net margins or the forward profit ratios of companies broken up into 5-year segments, right? So the color coding is showing us a month in that 5-year segment. And generally speaking, that's not exact, but generally speaking, what you'll see is as the forward net margin, as the profit margins have begun to rise, so has the forward PE, or the multiple that we are willing to pay for these companies, right? So it's not a story of us just being willing to pay more money for the same amount of earnings. It's as companies have gotten more profitable, we have been willing to pay more for them. And we've seen that if you look at the purple lines, which are showing you 2025 through 2026, compared to the early 2000s, which are all the way to the left, we are now paying roughly the same amount in terms of a PE ratio for companies that are significantly higher quality and have much higher profit margins. So yes, we are paying 22 times right now in terms of PEs, but these are for way better companies. And this is not your father's index. So on the left-hand side of the slide, you're able to see, going back to the 90s, the S&P 500's weighting composition of growth sectors versus value sectors. So growth sectors, think again, technology, communication services, as well as consumer discretionary. For value sectors, think financials, consumer staples, energy, and materials, right? And essentially, we've seen a flip flop, right? Growth sectors have pretty much doubled in terms of their weighting in the index from 30% in 1990 to nearly 60% today. And value sectors have been halved. They've gone from 47% down to 23%. And if we look on the right-hand side of this slide, of course, when the index composition is much more leaning towards growth right now, well, growth companies command higher multiples, right? So it's a very tight correlation where we can see the index is forward PE rising as the weighting of growth stocks in the index has risen along with it. So in summary, I would just say that if we think back to the first slide, inflation and interest rates are near-term risks that we want to keep an eye on. The new Fed Chairman Kevin Warsh has stated that the Fed will provide less guidance than past Fed chairs have and let the market dictate rate policy as opposed to the other way around. As we spoke about, the Strait of Hormuz is having a direct impact on energy costs, and obviously wars do cost money. So the Iran conflict is a direct tie into energy, which is a tie into inflation, which is potentially a tie into interest rates. The consumer is uneven, as we spoke about with the K-shaped economy, but the earnings story and growing margins are supportive of a strong market. I'll turn it back to you, Michelle, to finish off with you.
Thanks, Alex. I'll now pass it over to Yan, who will close us out with some very important matters to keep in mind.
Thank you, Michelle. Today, I want to talk about one of the most important documents in your financial life, one that most people rarely think about, and that's your beneficiary designation. It's the simple form attached to your retirement accounts, life insurance policies, and bank or investment accounts that tells the institution who should receive those assets when you're gone. What surprises a lot of people is that this form overrides your will. So if your will says one thing, but your beneficiary designation says something else, the beneficiary designation is what gets followed. Another major advantage is that these assets pass directly to people you have named without through probate, which means they can often receive the money much more quickly and with far less hassle. And when you think about it, retirement and investment accounts are often among the largest assets people own. So even though it's a single page that takes only a few minutes to complete, it has an enormous impact on how your legacy is passed on. On the next slide, I want to share a real-life example that demonstrates what can happen when beneficiary designations are overlooked. Many of you have probably heard of Prince, the legendary musician. When he passed away unexpectedly in 2016, his estate was valued at approximately $156 million. Despite being incredibly successful and meticulous about his career, he didn't leave behind a will or clear beneficiary instructions for his estate. So as a result, his assets became tied up in probate for 6 years before everything was finally settled in 2022. And during those 6 years, his family faced lengthy legal disputes, millions of dollars in legal and administrative costs. And because probate is a public process, the details of his estate became public as well. Now, most of us don't have an estate worth $156 million, but the lesson is the same. Uncertainty creates complication. Taking just a few minutes to review and update your beneficiary designations can spare your loved ones years of stress, unnecessary expenses, and potential family conflict. So let's look at our next slide, which highlights what you gain by keeping your beneficiary designations up to date. First, fast access. Your loved ones can receive their inheritance more quickly without waiting through a lengthy probate process, at a time when they may need it most. Second, privacy and simplicity. Assets transfer directly to your named beneficiaries and never become part of the public court record. third, control and certainty. You decide exactly who receives each account, and you can update those decisions anytime your family, financial situation, or wishes change. And finally, peace of mind. Clear beneficiary designations reduce confusion, help prevent family disputes, and make an already difficult time a little easier for people you care most about. And the good news is that this isn't complicated. It is simply about making sure your wishes are carried out the way you intended. In most cases, it only takes a few minutes to complete or update a beneficiary designation form. So before we wrap up today, I encourage each of you to take a few minutes to review your beneficiary designations. Make sure they're current, confirm you have named both primary and contingent beneficiaries, and reach out to your advisor at Ramapo Wealth Advisors if any changes need to be made. And that's all I have today. Back to you, Michelle.
Thanks, Yan. And thank you to all who tuned in to our July market update. If you have any questions, please feel free to reach out to your advisor. And as always, please let us know if you'd like us to send over today's slide deck. We appreciate you tuning in and hope you have a great rest of your day.